Hey everyone, welcome back to the channel. If you're new here, don't forget to hit that subscribe button and turn on notifications so you never miss our updates on global markets and economic trends. Today, we're diving into a topic that's been on many investors' minds. What could happen to the stock market if the wars in Ukraine and the Middle East escalate in 2025? As tensions in Ukraine and the Middle East continue to grow, the question on everyone's mind is, what if these conflicts escalate further in 2025? How will global markets, particularly the stock market, react? First, let's set the stage. As of late 2024, the war in Ukraine has already caused significant disruption to global markets. Rising energy prices, supply chain disruptions, and inflation are just a few of the effects we've seen so far. Meanwhile, the situation in the Middle East has been equally volatile, with ongoing conflicts in Israel, Gaza, and other regions adding to global uncertainty. There are several key factors that will drive the market's reaction to any escalation in these areas. Energy prices. Both Ukraine and the Middle East are major global energy players. If fighting intensifies, we could see oil and gas prices skyrocket, causing inflation to surge. This would weigh heavily on sectors reliant on energy, like transportation, manufacturing, and consumer goods. Supply chain disruptions. With more global supply chains at risk, particularly in energy, raw materials, and agriculture, companies could face even greater costs. This could squeeze profit margins and lead to a slowdown in corporate earnings, which would hit stock prices. Investor sentiment. In times of heightened conflict, markets become volatile. Fear-driven sell-offs often follow major geopolitical events, as investors move into safe havens like gold, government bonds, or even cash. So, how exactly will the stock market react if these conflicts get worse in 2025? Here's a breakdown of possible scenarios. Let's say the war in Ukraine intensifies, leading to further disruptions in the European gas supply. Energy prices could skyrocket, and inflation would continue to climb. Higher energy prices would hit businesses and consumers hard, leading to a decline in demand. Major indices, like the S&P 500 and the DAX, could see significant drops as investors fear an economic slowdown. An all-out war in the Middle East could lead to disruptions in oil production and shipping routes, sending energy prices through the roof. This would have a ripple effect across the global economy. U.S. markets could react with sharp declines, especially in sectors reliant on Middle Eastern oil or regional stability, such as defense, aerospace, and tech. At the same time, stock markets in oil-dependent countries could see some short-term gains, but long-term uncertainty would weigh on their economies. If both conflicts intensify at the same time, the stock market could enter a prolonged period of volatility. Investors could retreat from riskier assets, and the global economy might struggle under the pressure of soaring costs, geopolitical instability, and investor uncertainty. This could lead to a bear market, where stocks remain depressed for an extended period. In times of uncertainty, investors often turn to safe haven assets. Gold, U.S. Treasuries, and defensive stocks are typically seen as more stable during times of crisis. Historically, gold has been a go-to for investors seeking to hedge against inflation and geopolitical risks. Defensive sectors like healthcare, utilities, and consumer staples tend to perform better because people still need these products and services, even during tough economic times. But it's important to remember that markets are often forward-looking. While short-term volatility might hurt portfolios, the stock market has historically rebounded after major global crises. Long-term investors might see this as an opportunity to buy stocks at a discount, especially in sectors with strong fundamentals. So, in conclusion, while the worsening of the conflicts in Ukraine and the Middle East would likely lead to significant short-term market volatility, the long-term outlook depends on how these situations evolve and how global leaders respond. If history teaches us anything, it's that markets will adapt and the economy will find a way to recover. But that doesn't mean you shouldn't be prepared for the bumps along the way. Remember to stay informed, diversify your investments, and have a strategy in place. Thanks for watching, and let me know in the comments how you think the stock market will react in 2025 if these conflicts get worse. See you in the next video. Thanks for tuning in. Don't forget to like, subscribe, and hit the bell icon for more content like this. For more in-depth analysis, check out our playlist on global economics and stock market strategies.